Ladies and gentlemen, good day and welcome to Capri Global Capital Limited Q1 FY2024 earnings conference call hosted by Go India Advisors. As a reminder, all participant lines will be in the listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal the operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Ravikant Bhatt from Capri Global Capital Limited. Thank you and over to you, sir.
Thank you. Good morning, everyone. This is Ravikant. I shall read out a brief disclaimer for today's call. The discussion on today's call regarding CGCL's earnings performance will be based on judgments derived from the declared results and information regarding business opportunity available to the company at this time. The company's performance is subject to risks, uncertainties, and assumptions that could cause actual results to differ materially in future. Given these uncertainties and other factors, participants on today's call may observe due caution while interpreting the results. The full disclaimer is available on slide 42 of Q1 FY24 investor deck. Participants are requested to note the same. And I request our MD, Mr. Rajesh Sharma, to present the opening remarks.
Good afternoon, friends. It is a pleasure to welcome you all to the Capri Global's first earnings call of the financial year. We declared our reviewed consolidated results for Q1 FY24 on Saturday, 5th August 2023. I hope you had a chance to go through the investor's deck. FY24 shall be unique in some aspect. It will be the first full year of operation for the gold loan vertical. We aim to turn gold loan vertical profitable by end of this financial year. The equity we raised in March 2023 is fully deployed. It will add our core earnings and overall profitability. Keeping this in view, we will analyze our Q1 FY24 performance. Our disbursal increased 128% year-on-year to rupees 26.9 billion. Our disbursal momentum is usually soft in Q1 every year, due to which the disbursals have shown a 5% QOQ decline. However, because of the strong momentum maintained in the gold loan business, the decline has been muted compared to our performance in Q1 FY23. Excluding gold loans, our disbursal increased 65% year-on-year, but lower on 31% QOQ. This sequential decline is in line with the Q1 FY23 performance and seasonality of Q1 in lending business. Share of gold loans was 51% of Q1 FY24 disbursal, while MSME and housing was 12% and 11% respectively. The balance was contributed by construction finance and direct lending. The AUM momentum was marginally stronger than Q4 FY23, increasing 61% year-on-year to rupees 112.3 billion. AUM excluding gold loan was increased 38% year-on-year and 5% quarter-on-quarter. Share of gold loan continued to increase, rising to 14% of AUM compared to 11% in Q4 FY23. We expect our gold loans AUM to touch base or cross 30 billion rupees by end of this financial year. This could be 20% of AUM, assuming we sustain a 50% momentum of overall AUM growth. As you may have noticed in the AUM exhibit in slide 4, the momentum in MSME as well as housing portfolio was sustained, a healthy momentum despite a sequentially weaker disbursal quarter. In housing, we concluded a maiden direct assignment transaction with a leading housing finance company amounting to rupees 569 million at a competitive yield. Our on-book housing AUM is lower to that extent. The share of construction finance AUM was 17.5%. While growth in construction finance has been strong, please note that we are also guided by the share of this vertical in consolidated AUM of 20%. We are comfortable growing construction finance as long as our underwriting parameters are satisfied and the share of this book stays 8 or below 20% of AUM. We have reported a 38% year-on-year increase in our net profit to rupees 636 million. The profit is lower by a marginal 2% quarter-on-quarter. To fully understand the earnings, let me first start the core earnings. Our net interest income increased 77% year-on-year and 26% quarter-on-quarter to rupees 2,370 million. As explained on slide 16, this improvement was aided by both the strong equity funding of Q1 FY24 balance sheet as well as our improved spreads. Our weighted average yield on advance increased 55 basis quarter-on-quarter to 15.7%, while the weighted average cost of borrowing was up 20 basis quarter-on-quarter to 8.7%. You may recall our cost of borrowing had been steadily increasing through FY23 while the yield on advances was improving with a lag. This difference is visible in the segmental yield graphs on slide 15. As a result of these improvements, our spread stood at 7%, an improvement of 66 basis year-on-year and 35 basis on quarter-on-quarter. Our net interest margins were unsurprisingly at a robust 9.6%, a level we last reported in Q4 FY22. This was added, as mentioned earlier, by strong equity funding of Q1 FY24 balance sheet. As leverage improves, NIM shall mathematically decline. While we will enjoy the benefit of higher NIMs in the FY24, we would like to assess the earning efficiency of our lending business by the spread we generate. The share of our non-interest income in the net income was 25.4%, lower than 33% in QI FY23 and 30% in FY23. The dip was caused by lower car loan fee income owing to certain one-off adjustments. Secondly, the fee income tied to balance sheet, specifically MSME and housing finance, was also lower owing to softer disbursal during Q1 FY24. We expect this softness to reverse from Q2 FY24. The car loan fee shall also pick up momentum from Q3 FY24. The cost-income ratio declined marginally to 66% in Q1 FY24 from 68.2% in Q4 FY23. The cost-income ratio, excluding gold loan business, was at 50%. This is marginally higher 48% we reported for FY23. However, this too should reverse as earnings pick up during the year. In gold loan business, although our active branch network was 680, we had onboarded staff in another 60 locations as of June 2023. With branch work at various stages of progress, hence the operating expenses of Q1 FY23 also include partial OPEX of additional 60 gold loan branches. We had stated we shall pause branch expansion in gold loan business after touching a network of 750 branches by Q2 FY24. We have almost reached that level as we speak, and the incremental cost intensity shall steadily decline beginning October 2023. Our GNP ratio stood at 1.89%, 50 basis higher than Q4 FY23, but is substantially lower than the 2.7% ratio we reported in Q1 FY23. The PCR of the stage 3 assets was 27.8%. Our credit cost stood at rupees 239 million, which was higher than 120 million in Q4 FY23, but marginally lower than rupees 246 million we reported in Q1 FY23. As highlighted on slide 13, the average credit cost is trading 5 quarters is rupees 176 million. During the quarter, we made some accelerated provisioning on 3 construction finance exposure to a single entity amounting rupees 160 million. This was restructured and classified as NP, attracting a provision of rupees 50 million or 31% of exposure. We have initiated recovery proceeding in 2 exposures and in due course expected recovery of rupees 30 million. For the remaining rupees 130 million exposure, we are exploring various options for recovery. Despite the higher credit cost, including the one-off change, our credit cost to average asset under management ratio was 89 basis in Q1 FY24, in line with our pre-COVID long-term trend. Apart from the rupees 30 million recoveries mentioned earlier, we expect additional recoveries to happen in construction finance vertical in Q2 or Q3 FY24. There has also been a marginal increase in MSME NPAs and a slightly sharper increase in the housing finance NPAs. Our recovery efforts are continuous and we expect to improve asset quality going ahead. I would also like to additionally highlight that we do not see any structural issues here. We are aware of the rising pessimism on asset quality of NBFCs in general, retail loans in particular, given the lending boom of past 2 years. Nevertheless, Let me reiterate that we are not present in unsecured lending. Our lending is secured with very comfortable loan to value across all segments, whether retail or wholesale. This gives us comfort on managing our asset quality. We have reported 2.2% ROA and 7.1% ROE in Q1 FY24. Excluding the loss in gold loan business, our ROA and ROE would have been 3% and 9.6% respectively. As we move towards the break-even in gold loan business, our profitability should substantially increase, especially in H2 FY24. There shall also be additional drivers like the absence of one-off adjustment that shall contribute to the profit momentum. To conclude, I would say we have begun FY24 on a sound note. We shall deliver yet another year of sound business growth, but it will also be coupled with a very strong profit growth. With that, I conclude my remarks. We shall now take questions.
Thank you. Ladies and gentlemen, we will now begin with the question and answer session. Anyone wishing to ask a question may please press star and 1 on your touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Dev from Haitong Securities. Please go ahead.
Hi. My question is related to the overall composition of AUM. The MSME segment has come down from around 40% to around 35%. And earlier, I think you guided that it would remain north of 40% and in the range of 40 to 50%. So given the strong traction and the focus in the gold loan segment, how would the overall product mix look like going forward? Is there any kind of targeted mix that is there in mind? That was my first question. And second, I see that there's a increasing focus on co-lending in case of MSME as well as housing finance. Could you give us any color on that as well?
Yeah, thank you. So I think before gold loan, our key growth driver used to be MSME. When we launched the gold loan, and that also across about 750 branches. So while retail proportion in overall AUM have grown significantly, but if we talk about MSME, the disbursement plan and expansion remain the same. But since the gold loan has added to the overall AUM, that is the reason that MSME have gone a little bit down. If we look at down the line 2-year scenario, the gold loan composition will be about overall AUM 20 to 25% and MSME will be about 25 to 30%. And if you talk about housing finance, which is done through a standalone subsidiary company, housing finance is growing at a faster pace, about 50% plus. And with the back of branch expansion, that standalone basis will continue to grow at that pace for 40 to 50% in next 2 years.
Okay. Understood. Thank you.
Thank you. A reminder to the participants, anyone wishing to ask a question, may please press star and 1. The next question is on the line of Nikhil Niyati from Equirus Securities. Please go ahead.
Good afternoon, sir. Thank you for giving me the opportunity to ask a question. My question is regarding the MSME yield. Sir, I wanted to know what percent of our book is repriced, knowing that our yield has gone up this quarter, and how we can see the yield panning up in the future. Thank you, sir.
So, we have increased our long-term reference rate by 50 basis in the first week of April So our yield has been passed on to almost 60% of customer in MSME, 40% still remain on the semi-fixed. So those customers, the hike will not happen, but 60% customer of the past have already been increased by LTR of 50 basis. As far as the incremental lending is concerned, that is happening, maintaining the targeted spread in MSME. We are lending about close to 15.5% yield in the incremental lending we are able to maintain.
Okay, sir. Yeah. Thank you. Thank you for asking the question. Thank you.
Thank you. The next question is from the line of Raghav Garg from Ambit Capital. Please go ahead.
Yeah, thanks for the opportunity. Sir, just a few questions. Firstly, on the gold loan business. We've seen last couple of years there's been a lot of competition. Just a very high level question. What is your sense in terms of competitive intensity in this business? That'll be my first question.
So gold loan we have seen in last 2 years a lot of competition, especially coming in the lower rate segment by the public sector bank. So they are the new entrant where they are offering at a much lower rate, but their ticket size remains high. So basically, they are more focusing on a higher ticket size, and typically while theoretically they welcome all the customer, but they don't like to entertain the customer which comes for a 30,000 rupees or 50,000 rupees of loan. So there is a clear-cut demarcation between the customer segment. Among the gold loan finance company and NBFC also, the gold loan is not that like a product of unsecured lending or which can be done without proper investment in the branch expansion. So there is some sort of entry barrier. So we have seen that in among the NBFC, while we see in other product more than 30, 40, 50 player and a lot of regional player, in gold loan the major competition comes to the NBFC with the pawn brokers who lend at a very unreasonable high rate, and I think that is where the opportunity also lies. So this business will continue to grow. Looking at the overall AUM growth, the growth which is coming also because of the gold loan prices increasing, and a lot of people are open to borrow against the gold with the formal players. So if we talk about as far as the Capri is concerned with the 750 branches, and then branch will continue to grow, to build a AUM of 10,000-12,000 crore rupees in next 5-7 years is in overall economy, in overall the AUM of 3 lakh crore plus of the gold loan, it still remains very small and very much possible and profitable.
Yeah, sir, that's very well understood, and thanks for your answer. What I meant to ask is, in this quarter, how do you assess the overall industry competitive intensity to be, whether it's still as high as, what you highlighted a couple of quarters ago or last year, whether it's still as high as that?
You are talking about competition, you are asking about our growth?
Sir, I mean, both, in terms of your growth and, what is your assessment of competition and hence the impact on your growth or not?
No. So if we are expanding our branch network after the detailed analysis of the potential credit bureau, AUM, competition, we very well are on our target. Our branches are able to achieve the average growth of about 22 lakh month after month, and which is remain in our target. And our branches will achieve the desired profitability in the targeted time. And we are not going to stop even at 750 branches. So we clearly see the potential. Number two, some point of time, city-wise, we are going to convert our gold loan branches where they will also be sourcing business and leads for MSME home loan also. So overall, if you talk about the growth side, we are quite bullish and confident about achieving our growth target in the gold loan segment, and this vertical is going to be profitable once by the year end of all the branches will turn profitable, except which are opened recently.
Sir, what would be the break-even level for you in terms of, say, gold loan per gold loan branch, a dedicated gold loan branch? What would be that level where you would?
So, dedicated gold loan branch.
I think right now it's around 2.5 crores per branch, right?
So once it achieve a base of 3.25 crore, branch achieve the break-even. Anything above start contributing directly to the profitability.
Understood, sir. And sir, I mean, although I can calculate, but I just wanted to ask, what is the per branch expense that we would be incurring for a gold loan, typical gold loan branch for us, including the employee expense?
It is a city, and so we have branches which have 4 people, manned by 4 staff, manned by 5, manned by 6. So it is not a straight answer. So if our competition has a AUM of 30 crore, high potential segment is a low potential segment, depending on the size of the branch, the OPEX on the branch, and the manpower of the branch is put. It ranges right from 1 lakh rupees per month operating cost to up to 2 lakh 25,000 rupees operating cost, depending on the location and its potential.
So this operating cost is apart from the employee cost, correct? These would be the other.
This is all the operating cost, entire operating cost, including salary and all.
Understood. So just one last question. I understand that you have a branch in Vasai and Virar. So just today there's been an article in Hindustan Times that the police has bust a major fake document racket in the construction sector. The number of flats involved here are about, or rather the number of families involved are about 3,500 who were basically sold these flats. Now they would have taken loans from some of the financiers which are in that area. Would we have any kind of exposure to this project in Vasai and Virar, if you are aware of that? That is.
I don't think that we are doing any under construction project financing and housing finance vertical at all. So we don't finance any project at all unless it is ready. That is the policy we follow in affordable housing segment.
Understood. Even at the retail level, right?
We don't fund any under construction.
Understood. Thank you, sir. That's very helpful, and that's all my question.
Thank you. The next question is on the line of Bunty Chawla from IDBI. Please go ahead.
Yes, thank you for giving me the opportunity. And similarly, continuing with the gold loan branches. So as we have seen earlier, we were competing at lower interest rate at around 15% yield. Now we have moved to the competition layer at around 19.5-20%, which is visible on the yield per se. So how do you see now the growth for you being the equivalent rate with your competition? And secondly, on the branch expansion you said, so we believe that up to 1,000 branches, you don't require any approval from the RBI, right? Now, after 1,000 branches, how the approval, have we applied for any approval and all, and how we should see the branch expansion along with the AUM growth for the gold loan? Hello.
So your first part of the question was related to the yield. When we initially opened the branches, when first entered August 2022, that time we have launched some low rate of interest gold loans to create a buzz, to create awareness, which we have already achieved. From the January quarter onwards, we have started going for the high yield and the low value loans, like where average ticket size was less than 1 lakh rupees, where the yields was better. So gradually now our average onboarding of the customer is coming at about 16.5, 17%, and plus the default rate of interest is also being earned. So effective yield is now upward of 19%, and we continue to follow that philosophy in line with the market. if you talk about the RBI regulation of 1,000 branches, that is per company. So our still we have a scope of about 200 branches more, because this 849 branches also include the housing finance branches, which is housed in a separate subsidiary company. And after 1,000 branches, we'll apply to RBI, and we don't see any issue in getting the approval per se.
Okay, sir. So secondly, on the construction finance, now as we are seeing that there is a good boom, or real estate has been quite strong currently. But as we have historically seen, we have felt across the industry some NPA issues in the construction finance side. Now we are very much aggressively growing construction finance. So my sense is, queries, what steps or what different we are doing so that if there is any real estate cycle goes down, there should not be any negative surprises from this construction finance segment.
So first of all, I want to say that we are not aggressively growing. We are growing what we have strategically planned. So we have always said that we will do a overall AUM basis 20% construction finance and 80% is going to be retail loans, secured retail loans, and that is the same philosophy and principle we are following. Within a quarter, sometime it happens that your construction finance crosses 22%, 23%, or some quarter it comes to 19%. But you see, year after year, it has always remained within the 20% range. Second thing, we follow a very unique strategy of funding to developers which are smaller. So we are not going the ticket size of 200 or 400 crore type. Our average ticket size still remains less than 20 crore rupees even today. So you can imagine the kind of a small developer we are funding, and then we take a clear mortgage of the property. The smaller projects are completed faster than we don't fund the 40-story project which takes 6 years or 5 years to complete. So this turnaround time is faster. There is no interest cost accumulated when the project get delayed. So with these core lending principle keeping in mind on the construction finance, we see our all project gets completed within 3 years' time, and very strongly we feel that our 1/3 of the projects get balance transfer within 12 months. This speaks about underwriting standard also, where our repayment happens even before time because of the BT. And in our other projects also, we have seen that 50% of the balance project get prepayment than the repayment. So they get because of the faster sales. The strong cycle of the construction finance is helping the inventory to move faster. Even the cycle, your turns slightly sluggish. Our safeguard mechanism of having a control on the cash flow and the security cover will always protect our principal and interest. And historically, we have seen that since last 4 or 5 years, we have not seen the major any write-off or any unpredictable risk. While it happens, but that remains within the tolerant range of 1%.
Thank you, sir. Thank you. That was very helpful. So lastly, on the stage 3 assets, we observed the provision coverage ratio has come down from 30% to 27.28% kind of a thing. So what is the outlook on stage 3 assets provision coverage ratio? Because what we have observed in large NBFCs generally try to maintain 45 around percentage of PCR, so that if there is any hiccups going forward, that should be safeguarded against this high PCR part. Hello.
Yes.
Am I audible?
Yeah. So we are keeping the RBI regulates that it should be based on the PGD and LGD, and it should not be minimum 25%. So we are following that. And if you look at our overall the gross NPA, you can clearly see that there is a downward trend. From the last year of 2.7%, it has the gross NPA has come to 1.9%. And net NPA has come from 2% to 1.4%.
So on a normal basis, long-term basis, can we say 28-30% is the PCR we are comfortable with?
Yes. Keeping in our asset quality, which is all secured, and where the hard collateral is there, either the self-occupied house or business or gold. So that also gives us comfort when you are keeping this kind of PCR. In our past time, you're not seeing that our NPA, even the worst cycle of COVID, ILFS, DHFL, when there was a different kind of a crisis, our NPA gone any given point in time more than 4%.
Okay, sir. Okay. Thank you. Thank you very much. Best of luck for the future.
Thank you. A reminder to the participants, anyone wishing to ask a question, may please press star and 1. The next question is from the line of Mayur Liman from Profit Mart Securities. Please go ahead.
Thank you for the opportunity and congratulations for a good set of numbers. Sir, my first question is how you are seeing the incremental demand in MSME segment. Any specific segment or geographies we are seeing a strong demand? Are we confident that we would be able to deliver 30% kind of growth in this segment?
You are asking any particular segment?
Yes, MSME segment or any segment where we can see the strong demand.
MSME and second one?
Sir, can I repeat my question?
Yeah.
Okay. How you are seeing the incremental demand in MSME segment? Any specific segment or geographies we are seeing a strong demand?
So I'll answer this question. Wherever we see the strong demand, we put more branches. So likewise, we have more branches of MSME in Rajasthan, and then followed by Madhya Pradesh, and then Gujarat, and then Maharashtra, and then NCR. So basis that, so we clearly see, we expand in those geographies where we see the demand and also good collection efficiency. And so we clearly see the demand is very good in Rajasthan, Madhya Pradesh, and Gujarat. And that is how our branches are.
Okay, sir. And are we confident which segment is a strong now we are seeing in terms of the demand, sir?
No, so overall basis, our MSME demand is very good. It is a segment which is largely underpenetrated. If we talk about India have more than 70 million of MSME, which are only 20% their credit demand is met by the formal lenders. So there exists a strong demand, and I think there are many companies are focusing. We are few of them. We are one of them who are focused on MSME. And MSME will continue to grow 30% plus for next 3-4 years.
Okay, sir. And my second question is construction finance and housing finance vertical asset quality has deteriorated much this quarter. Specifically, construction finance, what would be the reason for the same and your future outlook on the asset quality across these verticals?
So there is no asset quality has deteriorated. If you see overall basis, GNPA is lower than the even preceding quarter, and the net NPA is also lower. As far as the one of the account is concerned, where we have restructured, and on account of restructuring, we have provided the provision. But that account, we are quite confident, and this is one of the account of the overall portfolio. It is not that there are many accounts have slipped away. And in this lending business, we'll always see when we are operating 180, 190 construction finance account, 1, 2, 3 account can always will face some challenges which we have to